There's a report that drops every single week. Most people scroll right past it, but the ones who actually read it, they saw February 2024 coming from a mile away. Silver shot from the low 20s, straight into the high 20s. No warning, no second chance. Now, that same pattern is showing up again. The longs have vanished. The shorts are piling in. And if history doesn't just rhyme, but repeats, we might be standing at the edge of something big. But here's the thing nobody's telling you. Welcome to Currency Archive. You know, I always tell folks, especially those of us who've seen a few market cycles come and go, if you find value in what we're uncovering here, do me a kindness and hit that subscribe button, would you? Think of it like bookmarking wisdom you might need tomorrow. And I'm genuinely curious, where in the world are you watching this from today? Drop your city or country in the comments. I love seeing how far these insights travel. Every Monday morning, a document appears on a government website. Most traders never open it. Those who do rarely understand what they're actually looking at. But there are people, quiet professionals with decades of experience, who wait for this report the way a meteorologist waits for satellite data before a hurricane. They're not looking for entertainment, they're looking for extremes. And right now, in the silver market, an extreme is building. The report is called The Commitment of Traders. It tracks who owns what in the futures market. Not names, not faces, just categories. Money managers, commercial hedgers, small speculators. The report shows their positions every single week, down to the contract. Most people treat it like background noise, but those who study it closely remember what happened in early 2024. February of that year, silver was trading quietly in the low 20s. The managed money crowd had walked away. Their long positions had collapsed. The shorts were stacked high. Everyone seemed convinced silver was going nowhere. Then something shifted. Within weeks, silver climbed from the low 20s straight into the high 20s. No dramatic news, no viral headlines, just a quiet, relentless move that caught most people off guard. The ones who weren't surprised, they had been watching the positioning data. Now, that same pattern is appearing again. Managed money has exited. Long positions have evaporated. The shorts are piling in, and the question every serious market participant is asking is simple. Is this the setup or just noise? Because there's a difference, a critical one. Positioning extremes can signal turning points. It just shows what happened. And what happened recently is this. The group that typically chases trends, the algorithmic funds, the systematic traders, the hot money, they've pulled back aggressively. Their long exposure has dropped to levels rarely seen outside of major market bottoms. On the other side, commercial players, the producers, the refiners, the hedgers have built up short positions, big ones. To many observers, this looks like a classic contrarian setup. When the speculators flee and the hedgers load up, it often means a bottom is near. But here's where the analysis gets serious. Positioning data is not a crystal ball. It's a thermometer. It tells observers the temperature of sentiment. It doesn't tell them what will change that temperature. Throughout 2022 and 2023, there were moments when silver positioning looked equally extreme. Managed money left, shorts accumulated, the pattern looked textbook. Yet prices continued to drift lower, or they chopped sideways for months. The positioning extreme existed, but the catalyst never arrived. So the question business leaders and strategic thinkers must ask is not whether the positioning looks interesting. It does. The question is whether the conditions exist for that positioning to matter. Because silver is not just a speculative asset. It's an industrial metal. It's consumed in solar panels, electric vehicles, electronics, and an expanding list of technologies. Demand is rising in sectors tied to the energy transition and digital infrastructure. At the same time, supply is not keeping pace. Primary mine production has flattened, secondary sources are limited, and much of the world's silver comes from regions facing geopolitical and operational challenges. This is where the positioning data intersects with something deeper. If the fundamentals are shifting, if industrial demand is accelerating while supply remains constrained, then the positioning setup becomes more than just a technical curiosity. It becomes a potential trigger. But the word potential is doing heavy work in that sentence. What converts potential into reality is the arrival of a catalyst, something that forces the market to reprice, something that makes the speculators who left reconsider, something that turns a quiet extreme into a scramble. That catalyst hasn't appeared yet, but the positioning says the market is coiled. And if the right conditions emerge, if fundamental pressures align with this technical setup, the move could come faster than most expect. The professionals watching this data aren't making predictions. They're preparing frameworks. They're asking the right questions. Not, will silver surge? But what would need to happen for this positioning to matter? And they're watching carefully. Because in markets, timing is everything. And right now, the clock is ticking. There's a reason most people give up on the commitment of traders report within 60 seconds of opening it. It looks like a spreadsheet designed by someone who hates clarity, columns of numbers, categories with technical names, dates that don't match the actual trading week, and absolutely zero explanation of what any of it means. But buried inside that mess is something valuable. Not a prediction, not a signal, but a map of who's standing where when the music stops. The report divides market participants into 3 main groups. Each group behaves differently. Each has different motivations. And understanding those differences is the only way to make sense of what the numbers are actually saying. The first group is called managed money. These are the trend followers, the algorithmic funds, the systematic traders who chase momentum. When silver is rising, they buy. When it's falling, they sell. They don't care about fundamentals. They don't care about value. They care about patterns and signals and whether their models say the trend is intact. Right now, this group has almost completely disappeared from the long side. Their positions have collapsed, not slowly, not gradually, but in a sharp, decisive exit that suggests their systems flashed red and they obeyed without hesitation. This is what gets people excited, because managed money tends to be wrong at extremes. When they pile in at the top, it often marks a peak. When they abandon ship at the bottom, it often marks a turning point. But here's the part most observers miss. Managed money is a lagging indicator. They react to what already happened. They don't anticipate what's coming next. Their exit tells observers that the recent trend was down. It doesn't tell them what the next trend will be. So when someone points at managed money's collapse and says, "This is the setup," they're telling half the story. The other half lives on the opposite side of the ledger. The second group is called commercial hedgers. These are the producers, the refiners, the mining companies, the industrial users. They're not in the market to speculate. They're in the market to manage risk. A silver mining company that knows it will produce 1 million ounces next quarter doesn't want to gamble on price. It wants certainty. So it sells futures contracts to lock in a price today. That's a short position. But it's not a bet that silver will fall. It's insurance. Right now, commercial hedgers are holding unusually large short positions. To the untrained eye, this looks bearish, a massive wall of shorts stacked against the market. But experienced analysts know better. Commercials are often short near bottoms. Why? Because they hedge production when prices are low. When silver is cheap, miners lock in sales. When it's expensive, they reduce hedges and let production ride. So the commercial short position isn't necessarily a vote of no confidence. It might just be smart risk management in a low price environment. But there's a twist. Not all commercial shorts are created equal. Some are genuine hedgers protecting future production. Others are market makers and dealers who take the other side of speculative flows. When managed money exits long positions, someone has to take the other side. Often, that's the commercials. This creates a mechanical relationship. Managed money sells, commercials absorb, the positioning shifts. But it doesn't mean commercials are making a directional bet. It means they're doing their job. The third group is small speculators. These are the retail traders, the individual accounts, the people trading 1 or 2 contracts from home. They're the smallest players by volume, but they often behave like a sentiment gauge. When small speculators are heavily long, it usually signals optimism has reached the crowd. When they're neutral or short, it suggests fear or disinterest. Right now, small speculators are relatively quiet, not aggressively positioned in either direction, just watching. So here's what the full picture looks like. Managed money has fled, commercials are short, small speculators are neutral, and the market is consolidating in a range that feels like waiting. But waiting for what? This is where the positioning data stops being useful on its own. Because positioning can stay extreme for weeks, even months. The setup can look perfect and nothing happens. The market just grinds sideways, burning patience and capital. There were multiple times in 2023 when silver positioning looked similar to today. Managed money was out, commercials were short. The technical setup screamed bottom, and yet silver drifted lower, or chopped in place. The positioning was real, the extreme was real, but the catalyst never arrived. That's the trap. Positioning tells observers where the players are standing. It doesn't tell them what will make them move. For the current setup to matter, something has to change. A fundamental shift, a policy announcement, a supply disruption, a demand surge, something external that forces the market to reprice. Without that catalyst, the positioning is just a photograph, interesting to study, but not actionable, and that's what separates professionals from amateurs. Amateurs see the positioning and assume the move is coming. Professionals see the positioning and start asking what needs to happen next. They build frameworks. They monitor conditions. They wait for confirmation. Because in markets, being early looks exactly like being wrong. There's a factory in China that most people have never heard of. It produces solar panels, millions of them every year. And inside each panel, there's a thin layer of silver paste that conducts electricity from the photovoltaic cells. Without that silver, the panel doesn't work. The factory doesn't care about the commitment of traders report. It doesn't track managed money positioning or commercial hedger sentiment. It cares about one thing only. Can it get enough silver to keep the production line running? And right now, across hundreds of factories like this one, the answer is becoming more complicated. This is where the story moves beyond charts and positioning data. This is where the real pressure is building. Because while speculators argue about technical setups, the physical world is quietly tightening. Solar panel production has exploded over the past 5 years. Nations racing toward carbon reduction targets are installing photovoltaic capacity at unprecedented rates. China, the United States, India, and Europe are all expanding their solar infrastructure. Every single panel requires silver. The amount per panel has been decreasing as manufacturers work to reduce costs. Engineers have developed thinner silver pastes. They've experimented with alternative materials. But even with these improvements, the total consumption keeps rising. Why? Because the number of panels being produced is growing faster than the efficiency gains. In 2020, the solar industry consumed roughly 90 million ounces of silver. By 2024, that figure had climbed past 120 million ounces. Analysts project it will exceed 150 million ounces before the decade ends. That's one industry, one use case. Now add electric vehicles. Every EV contains significantly more silver than a traditional combustion engine vehicle. The electrical systems, the battery management circuits, the charging infrastructure, all of it requires silver for reliable conductivity. As global EV adoption accelerates, so does silver consumption. China is leading this transition. Europe is following. The United States is investing heavily. And emerging markets are beginning their own shifts. Then there's electronics, consumer devices, medical equipment, 5G infrastructure, data centers processing artificial intelligence workloads. Each of these sectors uses silver, not in massive quantities per unit, but cumulatively across billions of devices and thousands of facilities, the demand adds up. And here's the critical point that most market observers miss. Industrial demand for silver is not discretionary. It's not something that can be paused when prices rise. A solar panel manufacturer can't stop production because silver got expensive. An EV company can't halt assembly lines. A data center can't shut down because component costs increased. They pay the price, they adjust margins, they pass costs downstream, but they keep buying. This creates a fundamentally different demand profile than investment demand or speculative positioning. When managed money exits silver futures, it doesn't reduce industrial consumption by a single ounce. The factories still need the metal. Now flip to the supply side. Silver is rarely mined as a primary product. Roughly 70% of global silver production comes as a byproduct of mining other metals: zinc, lead, copper, gold. This creates a structural problem. When zinc prices fall, zinc mines reduce production. When they reduce production, silver output falls too. Even if silver prices are rising, the economics of the primary operation drive the decision. Silver is just along for the ride. Primary silver mines, the ones actually targeting silver as the main product, have been struggling with declining ore grades for years. The easy deposits were found decades ago. What remains requires deeper drilling, more processing, and higher costs per ounce. New projects face permitting delays, environmental challenges, and capital constraints. The timeline from discovery to production can stretch beyond a decade. Meanwhile, existing mines are depleting. Production from major silver-producing nations like Mexico, Peru, and China has plateaued. There's no supply surge coming. There's no sudden discovery that changes the equation. And recycling, while important, can't fill the gap. Silver recycling is efficient in some applications like photography and certain industrial processes. But once silver is embedded in a solar panel on a rooftop or dispersed across millions of electronic devices, recovery becomes economically impractical. The metal is effectively lost to the supply chain for decades, so the picture looks like this. Demand rising across multiple structural growth sectors. Supply constrained by geological reality and economic limitations. And a market structure where the majority of silver comes as a byproduct of other mining decisions. This is the fundamental backdrop that exists regardless of what positioning data shows. But there's another layer. Silver sits at an unusual intersection. It's an industrial metal, but it's also a monetary metal with thousands of years of history as currency and a store of value. When concerns about currency debasement rise, some investors turn to gold, others turn to silver. It's more affordable per ounce, more accessible to smaller investors. And it carries the same historical monetary legitimacy. Central banks worldwide have been navigating unprecedented fiscal and monetary conditions. Debt levels in major economies have reached peacetime records. Currency volatility has increased. Trust in fiat stability has been tested. In this environment, silver attracts a different kind of buyer. Not speculators chasing momentum, not managed money following algorithms, but patient accumulators who view the metal as insurance against monetary uncertainty. These buyers don't show up in futures positioning data. They buy physical metal, they store it, they hold it, and their demand is invisible to the commitment of traders report. So when analysts look at positioning extremes and fundamental tightness simultaneously, they're seeing two separate forces that could converge. Positioning extremes create the technical setup. Fundamental tightness creates the underlying pressure. What's missing is the spark, the catalyst that makes the market wake up and reprice based on reality rather than sentiment. That catalyst could be a supply disruption at a major mine. It could be an unexpected surge in solar installations. It could be a policy shift that accelerates industrial demand, or it could be something in the monetary system. A currency crisis, a debt event, a loss of confidence in paper assets. Nobody knows what the trigger will be or when it will arrive. But the conditions are building, the fundamentals are tightening, and the positioning data says the market isn't paying attention yet. Which means when the catalyst does appear, the repricing could happen faster than most participants expect, because the market is structured for complacency, and reality doesn't wait for consensus. There's a moment in every market cycle when the data looks perfect, the charts align, the fundamentals make sense, the positioning is extreme, every indicator points in the same direction, and then nothing happens. Weeks pass, months pass, the setup remains intact, but the price barely moves, confidence erodes, doubt creeps in, and eventually most people walk away. Then, when almost everyone has given up, the move finally comes. This is why experienced analysts don't treat market setups as certainties. They treat them as probabilities. And probabilities require frameworks. So the question isn't whether silver will surge. The question is what conditions would need to exist for this positioning extreme to convert into actual price movement. Start with the bull case. In this scenario, a catalyst emerges within the next few months. Perhaps a major mining operation in Peru or Mexico faces unexpected disruptions. Labor strikes, regulatory shutdowns, infrastructure failures, something that removes meaningful supply from the market. At the same time, solar installations accelerate beyond current projections. Governments announce expanded renewable energy mandates. Private sector investment surges. Demand spikes faster than anyone anticipated. The physical market tightens. Premiums on silver bars and coins begin rising. Delivery delays appear. Industrial users start securing supply contracts at higher prices to guarantee availability. This creates visibility. Media coverage increases. Retail investors notice. And then the momentum players return. Managed money, which exited at extremes, starts rebuilding long positions. Their algorithms detect a trend change. Their systematic models trigger buy signals. And because their positions are starting from near zero, they have room to add significantly. Simultaneously, commercial hedgers begin covering shorts. Mining companies that hedge production at lower prices decide to reduce those hedges as prices rise. Market makers who absorbed speculative selling reverse their positions. The result is a feedback loop. Rising prices attract buyers. Buyers push prices higher. And a market that was positioned for decline suddenly reprices violently upward. In this scenario, silver could move from the mid-20s into the 30s within months, not because of hype, not because of speculation, but because fundamental tightness combined with extreme positioning created an explosive setup. That's the bull case. And it's plausible, but plausibility is not probability. Now consider the base case. In this scenario, the positioning extreme persists, but no meaningful catalyst appears. Industrial demand grows steadily but not dramatically. Supply remains constrained but doesn't face acute disruptions. The physical market stays balanced. Silver trades in a range. The low 20s become support, the high 20s become resistance, volatility compresses, and the positioning data, despite looking extreme, becomes irrelevant. Managed money stays on the sidelines. There's no trend to chase, no momentum to follow. Their models remain neutral and they allocate capital elsewhere. Commercial hedgers maintain shorts as part of normal business operations. Small speculators drift in and out without conviction. Months pass. The setup that looked so promising slowly decays. Not because the analysis was wrong, but because timing was impossible to predict. This happens more often than people admit. Markets can remain irrational or range-bound far longer than logical analysis. Perhaps global economic growth slows more than expected. Industrial demand for silver weakens. Solar installations decelerate. EV adoption hits roadblocks. The fundamental thesis that supported higher prices unravels. Or perhaps the monetary environment shifts. Central banks regain credibility. Currency stability returns. The fear that drove some investors toward precious metals subsides. In this case, managed money's exit wasn't early. It was correct. Their models detected deteriorating conditions before most analysts recognized them. Silver doesn't find support in the low 20s. It tests the high teens. The positioning extreme gets more extreme. and what looked like a bottom turns out to be a pause and a longer decline. This scenario is less likely given current fundamentals, but it's not impossible. Markets don't owe anyone a recovery just because positioning looks extreme. So how should decision makers think about this? First, recognize that positioning data is a tool, not a prediction. It identifies where participants are standing. It doesn't guarantee where they'll move next. Second, understand that fundamental analysis and technical positioning are separate inputs. Both can be true simultaneously. Fundamentals can be bullish, while positioning remains bearish for extended periods. Third, accept that timing is unknowable. The catalyst that converts setup into movement is inherently unpredictable. It could arrive next week, it could arrive next year. This doesn't mean the analysis is worthless. It means the analysis requires discipline. For business leaders with direct silver exposure, the implications are clear. Companies that consume silver in manufacturing should evaluate supply chain risk. Are contracts locked in? Are alternative suppliers identified? Is there buffer inventory? A price surge would squeeze margins. Preparation matters. For investors considering commodity allocation, position sizing becomes critical. Extreme setups can stay extreme longer than portfolios can remain patient. Allocating too much capital to a thesis that takes 18 months to play out creates opportunity cost and psychological strain. The professionals watching this market aren't making binary bets. They're building layered positions with defined risk parameters, small initial exposure, clear triggers for adding, predetermined exit points if the thesis invalidates. They're monitoring leading indicators, physical premiums, delivery times, industrial buyer behavior, central bank policy trajectories. They're asking confirmatory questions. Is the physical market actually tightening? Are industrial users scrambling for supply? Are monetary conditions deteriorating? Because without confirmation, positioning extremes are just numbers on a screen. And here's the broader strategic point that extends beyond silver. Commodity markets are telling a story about the real economy, about supply chains, about industrial demand, about monetary confidence. Silver's behavior matters not just for silver investors. It matters as a signal. If silver surges, it suggests industrial demand is overwhelming supply. It suggests inflation pressures are building in input costs. It suggests currency concerns are intensifying. If silver stalls despite positioning extremes, it suggests economic momentum is weaker than growth forecasts indicate. Either outcome carries information. Right now, the market is coiled. The positioning is extreme. The fundamentals are tightening, but the catalyst hasn't appeared. This is the moment that separates reactive thinking from strategic thinking. Reactive thinkers see the setup and assume the move is imminent. They overallocate. They lose patience. They exit at exactly the wrong time. Strategic thinkers see the setup and prepare frameworks. They define what would confirm the thesis. They size positions appropriately. They wait for evidence. Because in markets, being right too early is indistinguishable from being wrong. The clock is ticking. The conditions are building. And when the catalyst finally arrives, the move will likely surprise in its speed. But until that catalyst appears, discipline matters more than conviction. The setup is real. The question is whether reality will cooperate. And that answer hasn't been written yet.